Okay, well, look, we might make a formal start. Just a little bit of housekeeping before I hand over to Joel to formally kick things off this evening. Firstly, thank you everyone who's joined us. I'll keep the poll running for anyone who's not already answered the questions. Feel free to jump on there if you get a chance. If you don't want to, completely fine. Again, just to give us a bit of a snapshot of what to spend time on tonight. And as I said, we will keep this interactive. So any questions that you have, comments, concerns, feedback, things you'd like to spend for us to spend a bit more time on, just pop it in the chat or the Q&A box and we'll certainly get to it. If it's a bit more of an in-depth question, we might leave it to the end, just mindful of everyone's time. But feel free to just pop it in any time and we'll certainly get to it when we can. But on that note, I'll hand over to Joel to kick things off.
Thanks, Jarrad. So hi, welcome everybody. My name is Joel Kerin. I work here in Ally Wealth Management in South Perth. I'm a senior financial advisor here. I have been a financial advisor for 7 to 10 years, and it's just something really passionate that I love doing. And I suppose this role particularly helps me align well with connecting with Australians, particularly all over the world, whether they're here domestically or whether they're abroad. So every personal situation is different, but yeah, this just gives a little bit of extra flavour to it. So I'll just cross over through to the next slide. This here is our naturally, yes, there is a bit of a legal don't sue me slide. So this one just talks about all advice that you'll find here today is general in nature, and that if you find something that you might be applicable to you, feel free to reach out and we can obviously assess further. So the agenda for today's webinar is we want to go through, obviously we'll touch base on a little bit more of myself, a little bit on what Jarrad is, superannuation, how the changes that have happened, particularly within the most recent 12 months, and how we could maximise superannuation for the time that potentially you're abroad or when you're back at home and throughout retirement. Debt elimination versus investment strategies. So I get asked this question very frequently, and it is, Joel, do I pay off my mortgage or do I invest this money? We'll touch base on that. Obviously, a bit of a flavour of probably the last 2 years is cryptocurrency and NFTs. We'll touch on that and what you need to know. And then estate planning. This is just a pivotal moment of everything that sort of underpins financial advice, and it's a very important step to, I suppose, to go through. And lastly, tax residency, borders reopening. What are we going to have a mad rush of Australians coming back to the country? This is, I suppose, something we can touch on as well. So with that in mind, Ally Wealth, this is just, that's a picture of my beautiful office here in South Perth. You could probably see out the back of me, if I suppose the camera's probably small in the top corner, but it is in South Perth and the beautiful Perth city is behind me. Living here in Western Australia, we do have a completely COVID-free environment, so we are really lucky that we don't really necessarily need to deal with anybody else. So yeah, we offer a full range of full financial planning, including wealth management, investment advice, business insurance, personal insurance needs, and we service clients all over the globe. So I'll throw you over to Jarrad to take you through GFC.
Thanks, Joel. So yeah, look, a little bit about GFC, and I'm mindful that that nobody wants to hear too much from us on this topic, but just to give you a bit of background on where we fit into the market and exactly what we do, because it is important. Both GFC and Ally Wealth work together very closely and naturally. We both work with Australian expats, obviously GFC being licensed and registered in Singapore and Ally Wealth in Australia. Funnily enough, GFC actually set up in Sydney back in '97, and they'd made the shift to Singapore in 2003. And we're now the oldest non-aligned advisory firm in Singapore and one of the oldest in Asia. So we're not owned by any insurance companies. We're not owned by the banks, which for anyone who is paying attention with the Royal Commission and everything else going on in Australia, will recognise that that is quite important. A little bit like Ally Wealth, we work with Aussies all over the world. This is what we do day in, day out. So this is not just something we touch on. So we'd like to certainly think we're experts in the field. So enough about us. let's get into the content. So look, we thought we'd touch on and sort of kick off with the tax residency. This is a question that we get asked a lot. It's not the most exciting topic. I'm sure a lot of you have been bombarded with information on this exact topic. So I don't want to spend too much time on this, but if anyone does have questions, more than happy to answer them. So let's just run through what the current situation is, what has been proposed to change, what you need to think about as an expat if you're moving back to Australia. Naturally, a key flavour, a key theme of tonight is repatriation to Australia. So what do you need to think about? So look, firstly, just to set the scene, the current residency framework is a little bit of a mess. It's very old. We didn't really have a lot of fluidity in terms of Australians moving into Australia, out of Australia, working remotely, and all of the things that are quite natural today. So naturally, the test is quite old, it's quite convoluted, and one of the reasons for the proposed change, and it is just a proposed change at this stage, is to really simplify the framework, or at least that is what the Australian government is positioning it as. So at the moment, we have 4 tests. There are the resides test, the domicile test, the 183-day test, which most of you would be familiar with. That is, did you or did you not spend more than 183 days in the country? And then the superannuation test, which is largely for those people that work for the Australian government. So think DFAT, other Australian Commonwealth organisations that might be applicable for. The resides and domicile test are largely where your long-term residency is, who are you employed by, where are your clubs and memberships, where are your insurances based? Would it be reasonable for a Singapore citizen, for example, to belong to the Perth Rotary Club? Probably not. Yeah, that wouldn't make a great deal of sense. So that's really what the tests touch on. For anyone who's been on the ATO website, done the 4 questions around tax residency, no, that's not all there is to it. No, it doesn't mean you can spend 181 days in Australia and not be deemed to be an Aussie resident for tax. There is a lot more to it. And if you get hit with a tax residency audit, you'll very quickly realize that there is a lot more to it, because that audit has about 39 questions currently. So certainly not something that you want to be receiving. So what has been proposed? What could it mean for Australians in Singapore or for Australians in other countries around the world? As I mentioned, the idea here is to simplify matters. At least that's what we're being told. So first and foremost, there will be the 183-day test, and that is where the test starts. Did you or did you not spend 183 days in the country? If you didn't, then we move to the secondary tests, which are the factor tests, which simply boil down to if you spent 45 days or more in Australia in any given year, any given financial year, then you need to go to the factor test. And the factor test, there are 4 relatively broad and not simple at all questions. They are, do you have the right to permanently reside in Australia? So basically, are you an Aussie citizen or PR? Which would tick that box. Do you have Australian accommodation? This one is painfully vague, because does that mean, do you own property in Australia? Does it mean, do you own an investment property in Australia? Does it need to be vacant? What type of property? This one certainly needs a lot of fleshing out. The next one is, do you have family in Australia? Now, again, that should be financial dependents, so children under 18 or a spouse, which again, the tax residency tests are designed to be individual. So certainly not the be all and end all, one would hope. And then the final factor is, do you have significant Australian economic interests? Which again is inherently vague. Does that mean that you need $100,000 in the bank, or $1,000 in the bank, or 10% of your net wealth in Australia? Again, a lot of this needs to be fleshed out. The good news is that if you live in Singapore, the double tax agreement between Singapore and Australia will supersede this factor test. So what that means is that the 45 days doesn't really apply under the proposed change. And what does apply is back to the resides and the domicile test. So do you have long-term employment in Singapore, meaning 2 years or more? Do you have a long-term residency, i.e. property in Singapore, meaning 2 years or more? So that would be something like a lease that was signed for 2 years or longer. It doesn't need to necessarily be longer than 2 years, But if you're going month to month, which we find quite a number of Australian expats do these days, that might be deemed as not long-term accommodation in Singapore. Now, you might also be realizing here that if you don't live in a country with a double tax agreement, like Hong Kong, for example, then the 45-day test applies. So if you're thinking of moving to Hong Kong, I'm not suggesting that you don't. Maybe that's a very good opportunity. Maybe you have very good reason to do so, but be very mindful of what could happen here. Be very mindful of this space. Now, we then have commencing residency, ceasing residency. Now, for those that have answered yes, you are looking to return to Australia, commencing residency is probably going to be the big one. And we're going to touch a bit on that in terms of the repatriation checklist tonight. So I won't spend too much time on this, but in simple terms, once your plane hits the ground in Australia, if your intent is to return to Australia, you start paying tax in Australia from day one. There's a number of things to think about there. There's a number of factors there, but just be very mindful that it hits very quickly. There is then the ceasing residency. So if you're leaving Australia, how long does it need to be for? Again, it's largely down to that 2-year rule. Long-term accommodation, long-term lease, long-term employment, all of those things that support the fact that you've genuinely left the country. Now, look, we've created a bit of a roadmap here. I'm not going to spend too much time on this. It really just does step you through exactly what I've already covered. I'm mindful that I don't want to spend all of tonight, and I'm sure you don't want to be spending all of this webinar running through these tax residency changes. We will send out a copy of this. We'll send out a recording of this. So feel free to step through it. But in simple terms, be very mindful of the double tax agreement and watch this space. We certainly hope that the Australian government will consult companies like ours and obviously Ally in Australia dealing with Aussie expats, because the world has changed since 2019. But until that happens, naturally, we are doing a bit of shadow boxing here. So I'll throw back to Joel, who can talk through a bit of the repatriation side in terms of what you need to think about.
Thanks, Jarrad. So obviously, if you are planning on repatriation back here to Australia, obviously it's something that you need to consider. Give yourself plenty of time in order to, before you start literally jumping on the plane and thinking, do you know what, it's all going to work out. Generally speaking, we tend to see we start working with clients about 6 months out before their repatriation. And this is obviously just to ensure that these sort of things on this slide are sort of checked off. So they could be, starting to transfer your assets to Australia. If you have share purchase plans or employee share purchase plans, how they are dealt with if they're outside of Australia. Obviously, updating your addresses, health insurance, banking, that's all sort of comes part and parcel. One of the ones there is receipt of bonuses and commission payments. So if, for example, you do live in a country like Hong Kong or Singapore, which does have a much lower tax rate than what Australia does, if you repatriate and get paid that bonus, when you're back in Australia, you could be hit with Australian income tax on that. So it's really important to plan for this holistically and what your sort of work-life balance is going to be before you arrive back. And then, of course, there's the natural things like mortgages and loans here in Australia. Are you moving back into an investment property? Is there an opportunity there to, say, convert your loan to an owner-occupied rate and save yourself some interest? And jobs, housing, and superannuation strategies. So with that, obviously, in mind, I'll take you through the superannuation stuff. Sorry, just changing. There we go. So just recently, we've had a raft of superannuation changes that has taken effect here in Australia. So this is just, I suppose, highlighting a key level about what it looks like in today regarding contributions. So the superannuation transfer balance cap limit increase. So that increased from the 1st of July to $1.7 million. So that's really sort of welcomed to if you were to bring back or had a large superannuation balance here in Australia and you were planning to retire. This just essentially means that you can transfer larger sums of money into a pension account, which essentially provides you tax-free income. We do anticipate that over the next couple of years, this superannuation transfer balance cap will start to increase. It's anticipated to rise all the way up to 2.3 million eventually, but it's going to be a slow stepped approach at this. The downside of this is once you start a pension, you're set at that pension limit. So if you started the pension today, and you had $1.7 million in your superannuation account exactly, you started the pension for 1.7 million. Let's say in a year or two, the limit increases to 1.8, you can't then transfer an additional 100,000 into your pension. With the non-concessional limit increased as of the 1st of July, upwards to 110,000. So that means that is money that you're contributing after tax, essentially from your bank account into superannuation. The bring forward rule is also means you can trigger up to 3 years of non-concessional contributions in one go. So if we time that, I suppose, correctly, if you do have large sums of money that you wish to contribute, either from the sale of assets, you could time it potentially, you could do 110,000 in June, 330 in July, and then you've got $440,000 as a bulk non-concessional contribution. One of the things here that also isn't mentioned is the work test that was increased from age 65 to 67. So that just essentially means if you do continue working for longer, you have the opportunity to make contributions. One of the other things that I also welcomed as part of these changes was the concessional contribution carry forward rule. So what this means is if, for example, you had the sale of an asset where, for example, a capital gain was realised, you could essentially use up to 5 years of concessional contribution caps in one go if you hadn't contributed concessionally. So if you were living in Singapore and you didn't make any concessional contributions, you could come back to Australia planning to retire and say, right, well, I've got this investment property. I've got my primary residence here in Australia. I'm going to sell my investment property, which realises a capital gain. I haven't made concessional contributions for 5 years. You could trigger the bring forward on that and claim a tax deduction on that contribution. And so at the moment as well, the concessional contribution limit is 27,500 per annum. So that is monies that you add either from your employer, so SG contribution, or monies that you can add to superannuation and claim a tax deduction on.
Beautiful. So, I think just before we move on, Joel, I think just probably really just to reiterate the point there, I think the concessional carry forward is huge news for expats. I mean, obviously the main residence exemption on property is gone now, which was another horrific move by the Australian government that was made all too quickly. So if non-residents are selling property in Australia, there's not that many ways really to actually get rid of that tax. So at least we have a bit of an avenue now to explore, which, yeah, as you say, is really welcome news to expats. So certainly one to pay attention to, and I think one not to ignore.
Absolutely. So this page just really talks about the account-based pension. So you can see there that if you converted your superannuation account into an account-based pension, you could essentially draw even say 5%. Let's say we started at 1.6, drawing 5% of your account balance. Now let's just assume you get a return on superannuation or a dividend yield of somewhere between 3 and 5%, and a capital return of say 2 to 3. So all around 7% return. You're sort of hovering along that line where you could draw 5% and not be touching your capital yet. So that could be, and when in pension phase, that could be $80,000 to you completely tax-free.
Yeah, very important one. And I think, the other points to note, I mean, as Joel's already mentioned, we've kind of already touched on the concessional contributions. If you are overseas, no, it doesn't impact your tax residency as an expat. Unless you work for the Australian government, then it's a different story, but they're probably already contributing to your super fund already. So, there's a lot of myths, there's a lot of garbage we've seen floating around on Facebook, on various news wires around contributing to super is going to mean you're a tax resident. It is complete garbage. So if you do have tax liabilities in Australia, I would certainly encourage you to reach out, work out what you can do to get rid of them. The other really important part that we find, we get asked this question a lot by our expat clients, is if I'm investing on the Aussie Stock Exchange, well, I don't get franking credits. And the reality is, no, you don't. We also don't pay any capital gains tax or tax on dividends. So, let's not complain too much. But one of the things you can do is hold those fully franked dividend paying stocks directly inside your superannuation fund, and that way still utilize the franking credits. So a 4% dividend potentially becomes a 6% dividend just because you're getting that additional tax back. And correct me if I'm wrong, Joel, but I believe inside super, we're paying 15% tax on those dividends that are received. Now, ordinarily, a corporation in Australia is going to pay 30% tax. So if they are fully franked dividends, there's a bit of a differential we could potentially get back. Now, it's not to say throw all of your super into Commonwealth Bank or Wesfarmers or any other fully franked dividend paying stock, but certainly one to watch out for. If you are in, some managed fund, Colonial First State, AMP, whatever it might be, certainly a very important one to review and just check out your options there. And I think Joel's sort of covered the rest on this page here. This is certainly, obviously Joel's already touched on the account-based pension being a very tax-friendly way of generating quite a healthy income in retirement, whereas investment properties would be taxable. It's not to say property is bad, and we're certainly not, not the type of advisors that say you should never touch property. It's just to be mindful of what the tax treatment is going to be when you do eventually retire. So certainly if you are an expat looking to contribute to super or with taxable Australian income, have a look at your options just to illustrate exactly how that concessional contribution could work. As Joel's already highlighted, that limit is now 27,500. We'll just keep the numbers simple in this example at 25,000. It just makes the maths a little bit more round, a little bit more friendly, but just be mindful you can contribute up to 27,500. So if you had, for example, a positively geared property, meaning the money coming in exceeds the money going out, so the rental income is larger than the property management fees, the rates, the council rates, repairs, maintenance, etc., and interest on the loan, then ordinarily there is a tax liability, which unfortunately for non-residents starts at 32.5%. And that sucks. That's pretty high. Tax is one of the many reasons that many of us left Australia, for some of us many years ago. So we don't really want to pay 32.5% tax. So how can we get rid of that? One way is we make a concessional contribution to our super fund. Now, if you don't already have a super fund, you can still set one up. So obviously reach out to Joel on that front, set up a fund, set up an appropriate fund if it makes sense for you, and you can still make a contribution. So it's not a case of you ordinarily needing to already have one. You can still set up something new. And as you can see in this example, just by matching dollar for dollar, 25,000 of net rental income or capital gain, matched by 25,000 into super, means our taxable income is now nothing. Now, by contributing to super, we do need to pay 15% contributions tax. So very simple math, 32.5, take 15 is 17.5%. So for every dollar that gets contributed to super, it's 17.5 cents back in our pocket. Yes, it's locked in super, but up to you. Would you rather spend it or would you rather give it to the Australian government to spend? I'll leave that question with you. Seems like a bit of an obvious one. Just be mindful on this page as well. It should be clear, but just to be completely transparent here, you don't need to match dollar for dollar. If you have 25,000 of taxable income, yes, you can contribute 5,000 to your super, and yes, it's still tax deductible. It's just a small way of getting a little bit back and thereby reducing your tax liability. So one that I do every year. Now, before we move on to the next question, I might just cover off the question we've got come through because it is relevant to what we've just run through. So the question is, if you've been building up a bit of a tax credit through negative gearing, so negatively geared property over time, but now you have a positively geared property. Okay, so bit of a situation. Naturally, rents increase over time. At least we certainly hope so. Unless you're invested in a mining town or some other speculative real estate bubble, I guess, where that might not have been true. And that property over time, the rent increases. So you've moved from a negatively geared property, meaning the rent was less than the expenses, to a positively geared property, meaning the rent now exceeds the expenses. So the question then is, would the concessional contribution idea work until you work through your tax credits? So all of those losses that you've made over the years while your property was negatively geared, can you still make a concessional contribution to avoid using those credits first? And the answer is yes. Yes, you can still make a contribution. You can avoid using those credits straight away. You just can't create additional credits by making a super contribution. And Joel, feel free to correct anything I'm saying that's not quite right here. But what I would certainly encourage you to do is to seek proper advice, because what you're now dealing with is considering, is a super contribution better, or are you better off using your credits? And that's when you really need to think about the future. What are you going to be earning in Australia? Are you going to sell assets in Australia? There's a raft of things you really need to be reaching out to people like Joel for, and really consider what the future scenarios look like. Joel, anything to add on that one before we move on?
No. I think you touched on all of it. I suppose in that regards, obviously your carried forward credits, you have obviously an investment property as well. So if its whole purpose was to be an investment property, would you be considering in future to redeem that asset, in which you would be incurring then a capital gains tax liability? So is it more beneficial to use those tax credits to offset capital gains? It could, that's obviously my only additional point.
Excellent point. So hopefully that covers that question, but do drop us a note if there was anything else to touch on there. But otherwise, we might move on to the next section. So, well, Joel, I'll flick over to you.
Thank you. So this slide is really just talking about, so one of the, as I said in my introduction, one of the questions that I get asked quite a lot is, do I pay off my mortgage or do I invest in shares? And look, honestly, there is no right or wrong answer to either of these solutions. But what I usually question backward is time. So how much time do we want to hold property for? If it's your primary residence, like for myself, I'm relatively young, I own my own home. How much time do I have in order to pay that off? Do I have a long-term goal to pay that off? Obviously, if I'm also speaking to someone who's potentially 60 and about to retire and considering this option, do I pay off my home loan or do I invest in shares for say even a short amount of time? What is going to be the better option? What this table highlights below is time factor. So the risk of a negative return to kick in, obviously on cash, is basically non-existent. You're going to only have a loss on cash at a real return level. So CPI, particularly at the moment, is likely going to exceed the rate in which you're going to pay on cash. Fixed interest, obviously within any sort of 1 year, short periods of time. So then we still consider those in our financial planning world as a defensive asset, like bonds and credit. So in any sort of short-term arrangement, the chance of a negative return still exists within a short window. Property, again, what we like to hope, obviously, we have peaks and troughs in property, and we've seen it here, particularly in Western Australia, and I suppose speculative markets, where the risk of return is a little bit more drawn out. So, and equities, as you see there, the last line, do I invest in shares? Generally speaking, if you're investing in shares, you really need to take the long-term view about this. Because if you were, say, for example, in the 60-year-old case, invested in shares over paying off the mortgage, we then work through this. It performs well for 3 to 5 years, and 65-year-old man now says, I'm going to retire, and the markets crash. So what does that mean? That means that are we potentially now selling those shares at a loss in order to repay that mortgage when the mortgage could have already been repaid? So there's a bit of there's not necessarily a right or wrong answer, as I said, but we just need to be mindful of the time. So I'll just click through them. So this is just obviously some pros and cons of doing both. So they're paying down debt. Yes, guaranteed rate of return, non-deductible debt, peace of mind, interest rate outlook. Obviously, at the moment, we are seeing that interest rates on particularly debt in Australia are at record lows. And that's pretty much the case all around the world. So in some opportunities, it is a golden window to really hammer down debt in order to eliminate large chunks of it, because the cost of that debt is cheap. Whereas because of record low interest rates, particularly that also has the inverse effect on the cash rate as well, we see that investors are taking a little bit more risk in order to chase a return. So we see strong returns, particularly over since coronavirus hit in March 2020, when the market basically crashed completely. We've seen basically 30–40% rises in the ASX since sort of March 2020. So that has been ideal opportunities for some investors. And look, you can have speculation to say whether that is long-term sustainable or not. Regardless, it's still, some people could take that win and then do with it as they see fit. But we didn't know that that was going to happen in March, so we need to let time play out. As for the investing side, obviously, back to my point there, higher expected returns. That's just natural because you're taking on more risk. It could be more ideal for achieving longer term financial objectives. Liquidity is very important. So liquidity with shares, naturally, if, for example, you needed access to capital, you could sell down a very small portion of your share portfolio to access and realize that capital. Whereas the inverse of having property paid down, if you needed access to capital, well, you can't really sell your kitchen. You need to redeem that entire asset in order to have that capital released. And lower transaction costs generally we see with shares. There's not things like stamp duty, local government taxes, council rates. It's really just the dividends that you earn are attributed towards taxable income. But the market obviously is more volatile. So what we're going to see is it can be, I suppose, valued in 20-minute intervals, essentially. So you might see parts of your portfolio rising at some point and then falling. It could be a bumpy ride, but what we need to look at, again, is time. We need to see where we started to where we ended. So this is just really talking about removing the emotion. And Jarrad, I think you were reading the Dalbar study, yeah? Yeah, certainly. Look, this is an interesting one. I mean, for anyone who's not heard of this Dalbar study, this has been released for, gosh, the better part of 70 years, to be honest. And really what it's designed to do is to look at the impact of fear and greed of the average DIY investor. Now, it's very important to realize this is the DIY investor. This is not someone whose portfolio is managed by an advisor or a fund manager. This is the mum and dad punter at home managing their own investments. And about 60 years ago, when they first published this study, or 65 years ago perhaps, the numbers were almost identical in terms of the differential here. So every year it gets published, every year it's a 20-year block of time. So that way we get to sort of remove some of the cyclicality of some of these investments, some of these asset classes. And it looks at a very broad range. So from real estate investment trusts
to emerging market stocks, small cap stocks, high yield stocks, a diversified balanced portfolio. So you'll see here in the green and light blue, green blue boxes here. The green is the S&P 500. So some of the largest 500 companies in the world. See a lot of them based in the US. Then a 60-40 and a 40-60 portfolio. So what we would consider sort of a balanced and conservative or moderately conservative style portfolio. So over that 20-year block of time, which we're coming out of the dot-com crash, we've had the GFC, we had the end of 2019. Now this one probably goes a bit unnoticed. December of 2019 was actually the worst month for equity markets since the Great Depression. Not really caused by a great deal other than a raft of negative headlines that all seemed to hit at once. And then obviously we had COVID hit. Now you can see there, decent returns between 5.9 and 7.5%. Now, what did the average punter do? Well, we're down here in the orange, 2.9% per annum, which frighteningly is actually a lot better than most of these studies produce. Often the average investor is somewhere between 1.5 and 1.9. And 50 years ago, you could probably make the argument that it was fees. All of the costs of investing, brokerage, fund manager fees, it was all very expensive. Only the elite could really get a hold of good investment options. Now it's just fear and greed. We're absorbing so much information, Twitter, Bloomberg, CNN, heaven forbid, Fox, and all of the other garbage that is constantly at our fingertips. We can trade on our phone. I mean, goodness me, you can probably trade from your smartwatch these days. This is all getting a bit too fast. And I think the simplest way to put it is that if you had to talk for 24 hours a day, 7 days a week, you'd probably also come out with some nonsense. And this is the information that's being absorbed far too quickly. And that's why we're seeing these sort of very poor long-term average returns. So it's not to say don't invest. It's really more a lesson of self-awareness. If you're not someone who feels very comfortable managing your own investments, then outsource it to a professional. Naturally seek advice. So that's really the critical message there. I thought it was important that we put together at least one slide or one page on, look, what is the difference between paying off debt versus investing? I want to keep this very simple because there's a lot of assumptions that go into these sorts of calculations. This is not gospel to say, look, you should only ever invest, not pay off debt. But if we take some fairly broad, relatively conservative, long-term average assumptions, and let's just base it on an 8% annualized return. So a bit under the sort of average index return over the past 20, 50, and 90 years. And let's just assume that the long-term interest rate on our debt is 5%. Naturally, miles away from where we are at the moment, but just to give us some example. So what happens if over 20 years we pay off debt or we invest? Well, the reality is this. The investing outcome is the light blue and the paying off the debt is the dark blue there. So you can see there, it's about a $295,000, $294,000 difference over that length of time. Naturally, if you're in a jurisdiction like Singapore, Hong Kong, Middle East, lots of other tax-friendly jurisdictions out there, or you've got some sort of setup where the tax is fairly low in terms of impact, naturally this becomes even more attractive because you can realize those gains and not get hit with huge tax bills. So, it might even make sense for you to have a bit of a strategy where you're investing and gradually over time, dwindling down that debt or paying down some of the debt as interest rates start to rise. So look, I don't want to spend too much time on this because, as I said, it's not really to lead anyone in any direction. I just felt it important that we give a bit of a snapshot of what that number could look like. Okay, so look, before we move on to a far too commonly talked about topic, which we know a bit about, and on the crypto side, if anyone has any questions, any comments, as I said, do pop them in the chat or the Q&A box. But otherwise, we will move straight into the crypto space. Now, look, before we get into it, this is not going to be a which coin should you buy, which is the next Dogecoin or any of this nonsense. This is just a simple look at what's going on in this space, where do we, as advisors, as people who sit on investment committees, investment boards, see value in this space over the coming years, and what do we think you should pay attention to? So it's really to cover some of the basics. We're a lot more interested in NFTs than we are in cryptocurrency. We think digital currency will be the way of the future in some way, shape, or form. Which currency? Is it Bitcoin? Is it Ethereum? Is it something completely different? We genuinely think it's far too early to tell. So really want to spend a bit more time tonight on what I've called WTF is an NFT. There is a spelling error on this page. This graph was not designed by me. It was a PhD study carried out in Australia, funnily enough, and they spelled NFT owner incorrectly on the right-hand side there, just for anyone who hasn't picked up on that. So look, just to walk through this very simply, I'm not an IT expert. I'm a finance guy through and through. There are probably people on the webinar this evening far smarter than I when it comes to the IT side. So let's just walk through this very simply, because I'd rather spend time on where we see more value in the NFT space, in the smart contract technology, in terms of investment, than how the technology actually works. So look, very simply, an NFT is a non-fungible token. It is a digital asset that can't be replicated. It has a digital ID that is related to that particular asset. What you can do with that asset is dictated by the smart contract. The smart contract is what it all sits on top of, which is really where we see the greatest upside over time. Now, you're probably seeing some headlines around a lot of artwork that's being sold in the NFT land at the moment. 2017 was when the first NFT project launched. It's called My Curio Cards, sort of leading to the curiosity. So for anyone who's not already aware, check it out online. One set sold at Christie's in the US for $1.2 million. Just recently, that's US dollars. One set sold for, I think it was about 653,000 at Sotheby's last week. Does it mean they dropped in value? No, I think it just means that Sotheby's did a poor job in terms of PR. These were cards that were created for about $50 4 years ago. It's very early. There is a lot of artwork. There was an art piece sold by Beeple, the artist, for about 1.7 million. We're seeing artworks like CryptoPunk selling for millions of dollars every year. It's now the Bored Apes, the Mutant Apes, the Bored Ape Yacht Club. You can check out all this stuff on Twitter, Discord, and OpenSea. They are really the three channels that all of this stuff exists. So if you're interested, go and check out YouTube. I created a relatively simple video in terms of how it all works, what it all means. But it's very, very early days. We're really just at the starting point in terms of money flowing into this space. We're not suggesting you go out and buy artwork or digital artwork. We are suggesting go and do some research, because this is quite interesting to see what's going on here. We won't go through all the storage side, because as I said, I'd much rather spend some time on where we see some value. As I said, we are just at the beginning. Yeah, this stuff started in 2017. You can really see there the sort of blips in terms of money flowing into this space. Real money has really only been coming in over the last 12 months. We've seen Shaquille O'Neal, who else have we seen? Snoop Dogg, Eminem, some perhaps not the smartest of investment minds, but certainly some real money flowing into this space. And if you think back, if you have children, think to Farmville, Fortnite, all of these games that kids typically will ask their parents for the credit card to go and buy something on the game, a skin, a gun, some sort of upgrade, which is just a digital asset, which is kind of where a lot of this stuff has really come from. So we are at the starting point. As I said, watch this space. Where we are a lot more interested, just waiting for this to come through, is the potential use case of a smart contract. So if NFTs are confusing, Ethereum, blockchain, all of these new terms are a bit confusing. As I said, do some research. But what is most interesting in my mind is really the smart contract that it sits on top of. And by smart contract, I mean a contract that exists on the blockchain, so on tens of thousands or potentially hundreds of thousands or millions of servers that cannot be changed over time when it's bought and sold. It's completely transparent. The contract does exactly what the contract says. Now, why that's really interesting is to see really how this flows through different sectors. So where we can potentially see this as a bit of a disruptor is things like real estate. You know, imagine if you can create a smart contract for your house that you own or investment property that allows you to take a 1% commission for the rest of that property asset's life. So every time it gets sold, your great-great-great-great-great-great-grandchildren get 1% of the value of that property. Now, it's early days, there's a lot to unfold here, but once we start to think through some of these scenarios, it starts to get very interesting. You can fractional different assets. You might be sitting on a house worth $50 million and there might be nothing else. Well, as Joel mentioned, you can't just go and sell the bathroom. What you might be able to do is actually split that asset into an NFT contract and sell off different parts of it. Artists, musicians, bands who are looking to raise money, why is there now a need for a record label? You can go to the community, you can sell rights to future royalties, and people can buy those rights for relatively little money if you're new. If it works, naturally those rights are worth infinitely more money. So there's a lot to unfold. What I've called the flex factor here, you know, why do we buy gold watches? Well, the same thing is going to happen in the NFT space. You can see everyone's digital wallet. You can see exactly what they own, what they bought, what they sold, what they paid. So all of a sudden, you're going to be able to show the world what you spent money on, what concert you went to, because it will all become digital. So as I said, watch this space. We look at it closely. We look at it from an equity, from an ETF viewpoint, and we'll touch on a few ways to get exposure here. But certainly a very interesting space that I certainly wanted to spend a little bit of time on tonight. In terms of how you get exposure, as I said, there's a myriad of ways. Do you go and buy a crypto ETF like BITO? I don't own any. I'm not suggesting you do either. I'm not suggesting it's a bad thing either. Just do your homework. You can then go and buy direct equities that are exposed to the space. So for example, someone like NVIDIA, one of the largest video card manufacturers in the world, well, naturally there needs to be a lot of processing power in terms of digital currency mining. So there's a lot of peripheral ways to get exposure to this space without needing to figure out how on earth do I go and buy Ethereum or Bitcoin or something else. Obviously, you can go and buy direct crypto, direct NFTs, as I said. Check out YouTube. There's plenty of material there that teaches you how, and then obviously manage funds. Look, any questions on the crypto side, please do feel free to pop the questions in the box. But otherwise, we might move on. I'm well aware some are interested in the space, some are not. Some are thinking, what on earth is this guy talking about? So let's move on to something potentially more at the front of minds of a few more people. So Joel, I'll throw back to you here on the estate planning.
Well, here's hoping that my topic is a little bit less morbid than cryptocurrency. But like one of the most important things that, you know, we really do consider here in our financial planning world is sort of you've accumulated all of these assets, you know, working wherever that is across the world. What happens when the inevitable happens and you lose either a loved one or unfortunately something happens to you? So it's really important to consider that wherever you are in the world, they are different jurisdictions. And so it might be the case where you need to have multiple estate planning documents in place in multiple jurisdictions. Particularly here, I'll touch on the Australian ones. Obviously, the natural one is a will. So if you were to pass away, this is the distribution of your assets. Incorporating within your will could be a testamentary trust, which is essentially a trust structure that is only enacted in the event of your death. So that, in a way, protects those assets from potential claims against your estate. And more importantly, you can essentially have control around the distribution, the income from your estate, even when you're dead. So that is a very, I suppose, essentially a fundamental vehicle to ensure that your estate is distributed in accordance to your wishes. Then obviously enduring power of attorney, that is if you were to lose capacity, that would nominate someone that can make financial decisions on your behalf. And the last one there is your enduring guardian, essentially who's going to have the authority to turn off your life support. This is someone who really looks after and should know you in the best interests. So because they are the one that are going to instruct care on your behalf and know your wants, know your wishes. So those 4 documents at a bare minimum, if you have assets here in Australia, though they are essentially 4 items which you should definitely have in force. Now, I'm not an estate planning lawyer or myself or a solicitor, but by all means, there are plenty of local lawyers, solicitors, which essentially you can contact to enact these documents. Jarrad, obviously the Singaporean ones, I believe that they work in probably a very similar way compared to Australia.
Yeah, that's exactly right. I mean, obviously the critical differences in Singapore are you need to think about guardianship for the kids. Naturally, for most of us as Aussie expats, our permanent guardians, if we have children, probably don't reside in Singapore. So that might be family back home. You'll also want to think about temporary guardians as well here. So someone to look after the kids while they wait on parents or grandparents of the children, obviously. Parents of the parents or other family members to come and actually collect the kids. Make sure those nominations are in place. A bit of a statement of the obvious, but make sure it's not the maid, the helper, whose employment would be terminated in the event of your passing, because naturally they're not going to be much help as a guardian. And the other one to be mindful, I guess, of is really just the lasting power of attorney. The power of attorney documents are typically jurisdictional. So governments may recognise them, but a lot of the time you'll find they won't. So do your homework here. Make sure that you've got them in the jurisdiction you're living, residing in, and just make sure that the bases are covered.
Excellent.
So look, I guess the other considerations to think about here, and we're not going to go through all of them in great detail because there really is a lot to consider here. But if you are an expat, you're living abroad, if your beneficiaries are abroad, so your children, any other beneficiaries, there's a lot to think about. So you really need to speak with the financial planner, speak with the estate planning lawyer, solicitor, and make sure that the I's are dotted and the T's are crossed. So things like, as Joel mentioned, you might have a testamentary trust in your Australian will. Does a Singapore will recognise a testamentary trust? Can you simply transfer your Singapore assets into that testamentary trust? Do you have tax residents of the US that are going to inherit an Australian property? Can that have certain tax consequences if it's not dealt with in a specific time frame? Is there inheritance tax exposure? Inheritance tax is a funny one, or estate tax. Obviously, the two are fairly closely linked. If you're in Singapore and you own shares in the US, for example, you can only own $60,000 US before your estate becomes exposed to US tax. However, if you're in Australia, I believe the number's about 11.5, 11.6 million based on the double tax agreement. So how on earth do you deal with that? Should you just not own US shares? Should you adjust that when you go back to Australia? Certainly something to think about because those numbers are worlds apart. And naturally, think about the multi-generational wealth, think about bloodline trust, testamentary trusts, split families, who are your children going to marry or form relationships with over time? Obviously, all of these things need to be thought about and factored in. If you do own assets in different jurisdictions, should you have different wills? There's a lot to consider once you start having a bit of a global portfolio, and especially if you're living and working abroad.
So yeah, this obviously concludes the end of our webinar, and I just wanted to, I suppose, thank you all for attending. And if you do have any questions, would love to obviously reach out, if not in the chat box. Now, feel free to send us an email. Obviously the steps for us particularly, if you were to get in touch with myself and review any sort of assets or have any process, this is what it would look like in a very broad, simplistic term. We would just have a obligation-free chat, review the goals and objectives, and then we can put together a plan should you need to. And then obviously the flow-on effect from that is to implement that plan, obviously within all commentary. So if there was no further questions, Jarrad, did you have anything, I suppose, further you wanted to add?
Yeah, a couple of things. So we've just got a couple of questions that have just come through, which I'll touch on shortly. One thing just to mention, sort of in conjunction with Ally, we've put together a bit of a repatriation checklist. So for everyone who's joined us tonight, we'll send through a copy of that. It's a 3-pager. There's a lot to consider when it comes to moving back. And when you start to build these spreadsheets for clients, it starts to get a little bit terrifying, to be honest, for anyone who doesn't love spreadsheets. But we will send you through a copy of that. So that really kind of covers the basics, what you need to think about, who you need to reach out to, documentation to put in place. But just to let you know, that'll come through with a copy of the recording from tonight as well. So Joel, a couple of questions that have come through. So first one I might throw to you. So look, expat, they mentioned location, but it probably doesn't matter too much. So let's just say expat living and working in the UK, has a bit of cash in the UK, but moving back to Australia. Mm-hmm. They've created a will in the UK because they had some cash and shares in the UK, planning to basically move back to Australia for good. What should they do with that offshore will in terms of the Australian side?
So, of course, well, naturally, it would come down to ensuring that any sort of estate that you have in the UK. So let's just assume, so if they've only got cash left in the UK and they remove that and bring it all back to Australia, they're now back in Australia. Obviously, the next natural step is to have a new will created, and that just essentially revokes all previous wills. And I would even go so far to say how you would revoke that UK will, because I suppose the will in that jurisdiction is no longer relevant because you're not really dealing with any assets there. You are only purely dealing with the assets here in Australia. And an Australian will with a testamentary trust for your Australian assets and obviously local powers of attorney and enduring guardian. Obviously, if that's created before that and you've superseded those, it essentially makes it null and void.
Perfect. Well, hopefully that answers that question. But yeah, as I said earlier, drop us a note if that didn't. Okay, so the next question: how is SRS income taxed in Australia? So for anyone who's not in Singapore, SRS is is the supplementary retirement scheme. So it's a little bit like CPF, but it allows both Singapore citizens, PR and employment pass holders or expats in Singapore to contribute to, create a bit of a tax deduction. Now, SRS income and CPF income is taxed very similarly if you are in Australia. So if you're drawing an income from either portfolio and you are an Australian tax resident, that is taxable Australian income. There is no favourable treatment, there is no discount, there is no capital gains allowance just because you held the assets more than 12 months. It's taxable Australian income. So if you drew $50,000 from your SRS as income in that given financial year, then you pay tax at the marginal tax rate. So first 18 thousand tax free, then you start moving up the tax brackets in Australia. So a very good question, and appreciate this being raised because it really highlights the point that if you do have SRS or you have CPF, then it's really important to seek advice around should you actually remove it and transfer it into superannuation or into a different Australian investment portfolio or platform, because otherwise you may find that the tax can really bite. We've had lots of clients that have moved back over the years with CPF, thinking that their CPF annuity, their retirement annuity, CPF life, it's often called, is actually going to be taxable in Australia. Whereas if you have that money inside superannuation, it's not taxable. So really appreciate the question. Hopefully that answers that one, but do let us know if it didn't. Okay, so next question that has come through, and again, Joel, I might throw this one to yourself. So probably one we face all too often. Australian expat, worked in Singapore, moving back to Australia. Let's just create some fictitious times just to create a bit of an illustration here. So let's just say they move back, 1st of September just gone, and on the 20th of November, they're going to receive their $100,000 bonus. They're living in Australia now. The bonus is for their work in Singapore. How's it taxed?
Unfortunately, not at Singapore tax rates. It's at Australian tax rates. So the second, when you leave Singapore and you are coming and returning back to Australia, naturally, we're going to look back at that residency test. So the Australian government is going to do that assessment and say, right, well, you landed back in Australia on this day with the intent of residing here permanently. You've got a house here, you've got assets here, you've got intent to live here, reside permanently. So from that day onwards, you become an Australian tax resident, and any income that is derived from that day onwards is taxed at Australian tax rates. And when you lodge your tax return come 30 June the following year, you will have to declare the income that you've received, one, as a non-tax resident for the period of, say, from the 1st of July to, I'm sorry, Jeff, whatever that date was. You were obviously a non-tax resident during that time, and then you were a tax resident from then onwards. So if you are going to, in that case, if you are going to get paid a bonus, obviously it's very favourable to have Singapore tax rates, particularly in that instance. So I'd be questioning, do you want to have a holiday in Singapore at least until the end of September?
Excellent point. Yeah, so look, I think a very good one when you're planning your return dates. And I know we've certainly dealt with many clients over the years when they're looking at where they are when they receive their bonus. So no, look, I think that one's very clear. Okay, so just reading this next one. Okay, so this is a little bit different, and we haven't really spent any time on this tonight, but this is just around the 6-year main residence exemption when it comes to property. Hopefully everyone on the call knows that the main residence exemption was removed for expats. So if you lived in a property, you move offshore, if you're in Singapore and you sell it, as a non-resident, you pay tax from the purchase price. So yes, it's brutal. We won't spend any time going through the history of how that all changed. But the question is really related to how long do I need to go back and live in that property before I can claim it as my main residence again? So look, this is a question we get asked all too often. And the ATO's answer is not perhaps terribly helpful, but it simply must be your genuine intent to reside in that property, to live in Australia again. So 4 weeks leave, going on holiday to Australia, going to stay there so you can claim it as your main residence? No, the ATO is not quite that stupid, not at all that stupid, I should say. Naturally, the tax authorities talk to each other. So you would need to leave your job in Singapore, exit your lease in Singapore, update your address in Australia with every single provider you deal with to that new address, and genuinely live there. Now, if that was only for a month and you happen to then get another offer to go and work in Hong Kong or Dubai or wherever it might be, that may be perfectly legitimate, and you could legitimately reset that 6-year clock again. But again, it needs to be your genuine intent to go back and live in that property. So hopefully that covers that one. It's one we've answered a lot over the years, but certainly a good question. All right, well, Joel, I don't think we have any more questions. Hopefully we've covered everything, and hopefully everyone's got a lot out of tonight, but I'll hand over to you to wrap up.
Yeah. So yeah, thanks so much for joining the webinar. It's, if you found anything useful or anything there that you thought you'd like to elaborate on or didn't like, feel free to send us through some feedback. It would be really, I suppose, really good to get that feedback, just because we want to make these as, I suppose, without being a flood of information, but as purposeful as possible. So again, thank you so much for your time. Yeah, and we'll send you out a copy of this slide deck and this recording along with our checklist, and feel free to reach out should you need anything. Thanks so much.
Thanks, guys. Stay safe.